love the channel and find it useful in becoming a happy retiree. Subscribe today. Going to continue to go to the phones. Mike joins us on the line. Mike from Sandy Springs. What's going on, Mike? How can I help?
Hey, Wes, I've just got a quick question. I got a mother who's got a significant amount of money in a single state municipal bond fund.
Fund. Okay, so it's a fund, not a single municipal bond. Okay.
Correct. And I know interest rates are going to be going up, and I know about this relationship. I'm just curious what your thought is on, are the prices going to go? What kind of downside are we looking at?
So good question. So this really has to do with maturity, right? The length or duration of a bond. So if you buy a bond, and this is probably a good segue into what I wanted to talk about today anyway. If let's say you own a 30-year municipal bond, right? And it pays 3%. And that means the life of that bond, it doesn't mature for 30 years, let's say. Or let's say you bought it last year, there's 29 years left. Well, as interest rates go higher, and now you can go buy a new bond at a higher interest rate, that old bond that pays the lower percentage rate becomes less and less valuable because you can go buy the same bond in the same credit quality, let's say, but just has a higher coupon or a higher yield. And that starts to hurt the price of an old or existing bond, right? And if you think about it in terms of these long periods of time, a really long-term, low-yielding bond will become very unattractive because it has this long life of paying a lesser coupon, right? So it really matters when it comes to buying bonds. It really matters how long or what the duration or the maturity is on an individual bond, or if you own a fund, you want to look at what the duration is on that fund or the average maturity of that fund is. Now, you can buy a long-term bond fund, an intermediate bond fund, a short-term bond fund. So the bond fund itself has some sort of mandate. And I think that it's going to be real challenging over the next, let's call it the next year or so, as rates continue to move higher. If you own really long-term bond funds, you're going to expect the price to actually come down a little bit. Now, when you've got really high quality, you're not worried about the municipalities not paying their interest payments, right?
Quality space.
Yeah, and if you own treasury bonds, I'm not worried about the U.S. government not paying their interest, but I would be worried about getting locked up into a bond that has a really long duration. The last thing I want right now is a 30-year treasury or a 30-year municipal bond if rates are going up. So I think if you look at your mom's fund, Mike, just look at the duration on that and know that there's going to be some downside in price for a little while as rates go back up. And when they level out and we get to a place where you don't see interest rates going up and up and up every single day, that's when that to me, and I don't think that's that far away. I don't think we just keep screaming higher here. We get 3%, then 3.5%, then 4% of the 10-year treasury. I think it's going to be much more gradual than that. So just understand that you're going to see a little bit of price pressure as rates keep going up, but very often that is offset by the income that you'll be getting from the fund. So if you have an intermediate to shorter term bond fund, I still think you're fine. I still own those intermediate and certainly short term bonds. And I think over the course of the next year, as rates kind of settle in and figure out a new, slightly higher level, and I think we're getting closer to that, then that relationship will calm down, and you're not going to see giant losses every single time you open up your investment account because rates are going up and up and up and up. So that's my thought here. As long as there's a high credit quality, there's still a lot of safety and stability in fixed income. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.